So you've made it through the structure, content, and theory. Now comes the fun part. What not to do. In this chapter, we're going to look at the 10 classic mistakes and students make in exams and companies make in real life. Some of them seem small, but trust me, they can lead to major problems in presentation, compliance, and credibility. Let's sharpen your instincts and avoid the traps. Here's the mission for this session. First, to spot common mistakes in applying IAS 1. Second, to understand why they're a problem. Not just technically, but also from a user perspective. And third, to get ready for exam questions and real-life scenarios, where these errors show up again and again. It's time to look at what goes wrong, so you can get it right. This one happens all the time. Students, and sometimes even companies, confuse a profit or loss with other comprehensive income. They'll throw revaluation gains or FX translation differences into P&L, or worse, forget OCI completely. But IAS 1 is clear OCI is not part of operating results. It's separate, and you must split it into OCI items that can be reclassified to profit or loss later, and OCI items that will never be reclassified. Don't mix them, don't skip them, keep the structure clean. Now this one's sneaky. Some companies create their own subtotal like adjusted net operating core earnings. Catchy, right? They present it before our profit in bold, in red, with sparkle emojis. Okay, maybe not emojis, but still, it's made to look like the real result. IAS 1 says custom subtotals are allowed, but bottom only if they're built from IFRS recognized items, clearly labeled, not misleading, and not more prominent than official subtotals. So yes, you can show EBITDA, but not as the star of the show. This one is simple and dangerous. Companies change their presentation. One year they show expenses by e-function, next year by nature. Then they shuffle line items around and rename half the statements. IAS 1 says, be consistent, only change your presentation if it's required by a new standard or it clearly improves how useful the info is. Otherwise, stick with the format. Users need comparability, not a new layout surprise every year. Yes, the old let's just net it off approach. Example, revenue drives $100 million expenses, manage $80 million. So let's just report net income $20 million and save space. Nice try. IAS 1, absolutely not. You must show how gross values, unless a specific IFRS standard says you can offset, like deferred taxes in IAS 12. Why? Because users need to see the scale of both income and expense to understand business dynamics and risk. Here's a Goldilocks problem showing C needs too much ans or need too little m. Listing every $50 expense separately, or hiding a $5 million write-down under other expenses. IAS 1 is clear. Materiality matters. An item is material if leaving it out or misclassifying it could influence decisions. Materiality is contextual. For a startup, $100,000 could be huge. For a multinational, pocket change. The rule, highlight what matters, group what doesn't. Another classic mistake, and especially under time pressure, comparative figures are required for all financial statement items and all disclosures unless truly impractical. If you restate prior year amounts, you must explain what changed, why it changed, and how it impacts comparability, usually with reference to IAS 8. No comparatives, no context, and users need context. Let's quickly run through the biggest traps to avoid when applying IAS 1. Don't mix up profit or loss and OCI. They have separate purposes and rules. Don't invent flashy subtotals that mislead users. If you add one, label it clearly and keep it in proportion. Don't jump between presentation formats every year. Consistency is key. Don't offset assets and liabilities or income and expenses unless a standard specifically allows it. Don't ignore materiality. Focus on what truly matters to the user, and always show comparative figures, because financial information without context isn't much help. Get these things right and you'll avoid most of the real world and exam pitfalls. Let's finish with a quick reminder. IAS 1 isn't just about formatting, it's about discipline. These common mistakes can lead to misleading reporting, audit issues, investor mistrust, and of course, losing marks in the exam. So stay sharp, stay clean, and above all, stay IFRS.